Hello everyone, and welcome. Let's get straight into the analysis. The U.S. markets are closed for the weekend, so we'll be looking at the closing figures from this past Friday, October 24, 2025. Tilray brands, trading under the NASDAQ ticker TLRY, officially closed the session at $1.49 per share. This was up 1 cent or 0.68% for the regular trading day. In the after-hours session, it tacked on another cent, finishing at $1.50. Now, many investors will see that $1.50 mark and just wait. They see Tilray as the benchmark for the entire cannabis sector, the global, diversified leader in waiting, and they're simply holding on for that inevitable legislative catalyst in the United States. The expectation is that you just buy TLRY, sit on it, and wait for the SAFE Banking Act or full DEA rescheduling to send this stock flying back to its old highs. The reality, however, is that this $1.50 price point isn't a resting stop, it's a battleground. What's happening underneath this seemingly quiet price action is a far more complex story about cash flow, international strategy, and a truly significant, entrenched short seller position that is betting heavily against that simple wait-and-win narrative. The quiet chop you see on the chart, like the one from Friday, isn't consolidation. It's the sign of a massive tug-of-war between long-term holders and opportunistic shorts. Let's first establish the common ground. The general belief, the one that has attracted so many retail investors to Tilray, is that it is the safe way to play the cannabis boom. Unlike the U.S. MSOs, Tilray is listed on a major U.S. exchange, the NASDAQ. This gives it liquidity and access for investors who can't or won't trade on the over-the-counter markets. The company, led by CEO Irwin Simon, has also diversified heavily. It's not just a Canadian cannabis producer anymore. It owns Sweetwater Brewing, Breckenridge Distillery, and Montauk Brewing, among others. The strategy is clear. Build a CPG or consumer packaged goods portfolio of brands that are adjacent to cannabis. Establish a massive distribution network across the U.S., and then, the moment federal law allows, slot THC-infused versions of these products right onto the shelves. It sounds brilliant. It's an expectation of a seamless, dominant entry into the world's largest market. But here is where we must challenge that expectation with the current reality. That diversification strategy is expensive, very expensive. Acquiring these beverage brands costs hundreds of millions of dollars, and while they generate revenue, they also operate in highly competitive, low-margin industries. They haven't been the magic bullet to offset the continued struggles in the core Canadian cannabis market, which remains saturated, plagued by high taxes, and undercut by a resilient illicit market. So while investors wait for U.S. legalization, Tilray is burning cash to maintain this sprawling international empire, from its leadership position in the fledgling German medical market to its beverage brands in the U.S. The reality is that Tilray is in a race against time. Can it achieve sustainable positive free cash flow before it runs out of liquidity or is forced into more shareholder dilution? This is the core tension, and it's exactly what the short sellers are focused on. Looking at the recent trading action over the past few weeks, TLRY has been struggling to hold any momentum above the $1.70 level. Every time legislative optimism bubbles up in Washington, perhaps a new headline about the DEA's review to move cannabis to Schedule III, the stock sees a high-volume spike. But look at the pattern. Those spikes are met with immediate heavy selling pressure. The volume on the red days, the down days, has often been just as significant as the volume on the green days. This suggests that for every hopeful retail buyer, there is a large entity or a collection of them using that liquidity to either exit a position or initiate a new short one. The stock has been carving out a frustrating channel, and the intraday volatility, as seen on Friday's chart, is less about price discovery and more about algorithmic trading and options-related hedging around key psychological levels like $1.50. This brings us directly to the short-selling activity, which is critical to understand if you are involved with Tilray. This is not a guess. The data is public. As of the most recent reporting, the short interest in Tilray remains stubbornly high. We're talking about a significant percentage of the entire free float being sold short. This isn't just a few rogue traders. This is a broad, well-capitalized thesis. So what is the short thesis? It's not just cannabis is bad. It's far more sophisticated. First, the shorts are betting on dilution.
They see the company's cash burn and its balance sheet, and they know that Tilray has historically used at-the-market or ATM offerings to raise capital. An ATM offering is when a company trickles new shares into the open market, which can suppress the stock price. Second, they are betting that the legislative catalysts are non-starters. Their view is that even if cannabis is moved to Schedule III, it doesn't solve the main problem, the lack of interstate commerce. It might provide tax relief by removing the dreaded 280E tax burden, but it could also invite stringent FDA oversight, turning cannabis into a pharmaceutical-style industry, which is not the recreational boom everyone wants. Third, the shorts are looking at the fundamentals of the Canadian market and the slow growth in Europe, particularly in Germany, and they simply don't believe the company's path to profitability as clear as management projects. So what's your take on the rising short interest? Do you see it as smart money, correctly identifying fundamental weaknesses, or is it a coordinated effort to suppress a stock that has massive long-term potential? This is the debate raging on platforms like Reddit and X right now. You have a very vocal long-term community that sees this short pressure as artificial and is constantly on the lookout for a potential short squeeze. Now let's talk about actionable insights for you. How can you track this? You don't have to guess. You can use financial data platforms, many are free, some require a subscription, like Ortex or Fintel, to look up the TLRY short interest data. Don't just look at the percentage of float. Look at the days to cover or short interest ratio. This metric tells you how many days it would take for all the short sellers to buy back their shares based on the average daily trading volume. A high number, say over 5 or 10 days, can indicate a potential short squeeze setup, because if good news hits, the shorts are all trapped and must rush to buy back shares, creating a feedback loop of buying. But, and this is a huge but, a high days to cover can also just mean the stock is very illiquid and the shorts are comfortably sitting in their positions. Also, monitor the cost to borrow. This is the interest rate hedge funds have to pay to borrow shares to short. When this rate spikes, it means the demand to short is extremely high and the supply of shares to borrow is drying up. That is often a more immediate precursor to a volatile move. Chasing a short squeeze is exceptionally risky. Understanding the mechanics of the short position is just responsible due diligence. Let's briefly step back and clarify the business itself for those who are new to it. Tilray Brands is, at its core, a global cannabis lifestyle and consumer packaged goods company. It has operations in Canada, the United States, Europe, Australia, and Latin America. Its business is really split into 4 key segments. You have the Canadian cannabis operations, which was its origin. You have the international cannabis operations, primarily its medical cannabis distribution in Germany, which is seen as the next big growth market. You have the beverage alcohol segment, which we discussed, Sweetwater, Breckenridge, and Montauk. And finally, you have a wellness segment, which includes hemp foods and other products. The entire bull case, the entire reason people are holding, rests on CEO Irwin Simon's vision that this 4-pronged attack creates a diversified, resilient company that can weather the storm until the U.S. market opens up, at which point it will leverage its U.S. distribution footprint to dominate. The bear case is that it's a company doing 4 things averagely instead of 1 thing excellently, and that this diversification is just a costly distraction from the core problem of cannabis profitability. The company's last earnings report was a perfect example of this duality. Management focused heavily on its guidance for achieving positive adjusted EBITDA. And that's fine, but adjusted EBITDA is not the same as actual net income, and it's certainly not the same as positive free cash flow. Analysts and skeptical investors are digging past that headline number and looking at the cash flow statement. How much cash did the company actually burn from its operations? How much did it spend on acquisitions? And how did it fund that shortfall? Was it with debt? Was it by selling shares? These are the questions that matter. The company has made progress in cutting costs, especially after its massive merger with Afria, but the market remains deeply skeptical, as evidenced by the $1.50 stock price. Looking ahead to the coming weeks and months, there are several key signals to monitor. First, all eyes are on Washington. Any credible news from the DEA regarding its scheduling and review will move this stock, period. The expectation is that Schedule III is a done deal. The reality is that the timing is unknown, and the full implications are still being debated. Will it apply retroactively, allowing companies to reclaim past taxes paid under 280E? Probably not. Will it open the door for big pharmaceutical companies to enter the space? Possibly. This is not the simple legalization button everyone thinks it is. Second, watch the next earnings report like a hawk. Do not listen to the adjusted numbers. Go straight to the cash flow statement. Is the operational cash burn shrinking? Is the company guiding for positive free cash flow? If they can achieve that, the entire short thesis begins to crumble. As the threat of dilution fades, that would be a genuine fundamental catalyst. Third, continue to monitor that short interest data. If you see the days to cover ratio climbing while the stock price is holding steady, it could mean pressure is building. If you see the cost to borrow spike, prepare for volatility. This is how you can use data to prepare rather than just reacting to headlines. Comment below with what you believe is the single biggest risk for Tilray right now. Is it the continued cash burn, the persistent competition from the illicit market, or the risk that U.S. legislative reform disappoints? I'm curious to read your perspectives.